Folks, we are going to share with you a chart produced by Reventure Consulting that I think explains exactly why the crash bros have been wrong. It'll explain why the crash bros still are wrong. But before we do, let's go through a couple of quick items, such as what high interest rates are doing, what the Fed is starting to say. We will talk about the 10-year bond spike and the like. Again, folks, pay attention. I'm going to show you a chart from Reventure Consulting to kind of wrap this session up about why the crash bros have been wrong. I think it is clear as day and very well done. So I think Nick did an amazing job putting this out there. And I really think it highlights what all the crash bros have gotten wrong. So we will get into that in a minute. But before we do this, let's talk about higher for longer. As you know, the Fed has been on an interest rate increase for now, I think 13 months. They've taken the bond rate up 525 basis points, the quickest rise ever. And the economy is still seemingly strong. I believe we are just starting to see the delayed impact. Now, what am I saying? We have gotten some numbers specifically in the housing market that shows the housing market is going lower. The housing market is going lower. Now, what does that mean? Folks, remember, rates impact transactions. We are learning, or at least a lot of new investors are learning, that when you adjust rates, you not only have the demand issue, aka affordability, which everybody talks about, but you also have the supply side, which no one talks about, or at least no one talked about it until very recently. The supply demand curve that you learn in economics are two lines. The fact that you have focused on the demand side and forgotten that the supply side could be impacted shows you why you don't understand economics 101. We have seen supply constrained because who would sell a 3% house to take on an 8% mortgage? This is called lock-in or whatever you want to do it. We have an effective interest rate of 3.6%, which on other than taxes is your most expensive line item. The consumer, at least homeowners, doing pretty well, right? Again, we also have our debt structure is very different. I believe it was 86% of our debt is fixed, leaving only 14% that is variable. That is much different than historical averages. If you go back to 2006 and 7, I believe the numbers were more like 72% fixed, 28% variable. Why? Because a lot of mortgages were adjustable ARMs back in the day. So again, when your debt structure is fixed, you don't impact it. It impacts the next loan, the next purchase, the next investment. It doesn't go back and impact what you have already done. So what are we seeing? I believe the first indication of higher for longer was pending home sales last month, down 7.1%. Folks, that's off a very low number. So when you start having big drops off already very low numbers, it tells you something is coming. Mortgage demand down 6%, again, on a very low number. Rates matter. We are also seeing car payments up to $736, up 33% year on year. Folks, rates matter. It is starting to impact the consumer. It is starting to impact companies. It is starting to ripple through. Now, again, starting is starting. We have months and quarters ahead of us. I think these things will roll through for the next 6 to 9 months and prove the Fed is done. Yes, I believe the Fed is done in raising interest rates. I believe they will try to be on pause all of next year, higher for longer. They're trying to kill the Fed put. That was the conversation I had with Danielle DiMartino Booth on this channel. What was that, 6-8 weeks ago? If you haven't seen it, go see it. It was a wonderful, wonderful talk track. Again, on Saturday, we did more diving into the jobs number. Again, we had a really robust headline number, a huge beat, but wages were decelerating. We've had part-time growth versus full-time growth. The increases were in leisure, which again is typically below the median. I think what we're seeing is just what we've talked about, right? Below the median is going to get theirs. Above the median wages aren't. It's just where we are. I do think we're going to have More and more folks in the bottom half make more and more money, which is awesome. That is great. And then the last thing before we get into Reventure Consulting's chart is the 10-year note as of Saturday morning, and I think it's come off quite a bit, was already up 0.58%. The bond market was doing the Fed's job. Now, what has happened since Monday? Obviously, several Fed presidents have come out and told you, you know what? The market is doing our job. We're done. Folks, if you look at some of the numbers, it looks like the Fed went from being 60% raised this year to 60% done. Thankfully, we've talked on this channel ad nauseum about the fact that I think they are done. Alrighty, folks, what did Reventure Consulting produce that explains why the housing crashes were wrong? I want to give Nick full credit. He produces amazing charts, very graphical, very right in your face. And basically in this chart, I think it explains two things. Why did housing skyrocket in 2020 and 2021? Why were the housing crash bros so wrong? Second, why is housing doing better than all the crash bros think right now? All righty, Michael, you sold this chart a lot. Show it to me already. Fine. This is Nick from Reventure Consulting's chart. And as you can see here, let's get this out of the way. This is the real, not nominal. This is the real mortgage rate. 30-year fixed rate mortgage minus the inflation rate. And this goes back to 1985, folks. So as you can see, we have been on a downward trajectory. And then all of a sudden, the real mortgage rate goes negative. We actually talked about this as real estate investors. This is what I was screaming in 2020 and 2021. Folks, go get your 30-year fixed rate debt. You're borrowing for less. Your real interest rate is negative. And folks, hint, it's 30-year fixed rate money. There is a chance that some of your loans will be real negative for a long time. And if they're positive, they will be positive by 1 or 2%. This is exactly why Nick from Reventure Consulting is right. That blue portion, negative 4.3%. The real interest rate, again, was negative 4.3%. Nick is exactly right. This is why housing went up. Now, if you remember our discussions and the talk of the 50-year, 53-year spreadsheet, I showed you empirical evidence that 2020 and 2021 were the second and third best year ever to buy real estate on an affordability scale. It's just fact, but you didn't believe me. I couldn't produce the pretty charts like Nick, but Nick, you did it. This chart here shows why getting 30-year fixed rate debt and with a negative real number was a great idea. And again, remember, unlike the UK, unlike Canada, unlike New Zealand, you have 30-year fixed rate. This is why you're not selling. This is why folks are staying in their homes, because they have negative real rates. Now, again, let's say you have a 3% mortgage. And let's say inflation, what was the last reading? 3.7. Your real interest rate is negative 0.7. Eventually, inflation will be 2%. You will have a 3% mortgage. Your real interest rate will be 1%. But again, you had an opportunity. The crash bros were wrong, and Nick shows you right here that was a great time to buy assets at fixed rate. And then what about today? What about today? Well, Nick is really taking it to the crash bros one more time. He is saying, yes, affordability is bad. It is terrible, but it is not historically terrible. And again, we are operating in an environment where transactions are crashing. So we do not have to do 6.2 or 6.6 million units. We're going to do 3.7, 3.8, 3.9 million units. The supply is not there. Nick is right again. It is bad today. But if you step back, if you zoom out like Nick has done here, it is not historically bad. One would argue that it is right on trend. as Nick has shown you here. He has drawn a line at 4%, showing you the historical average back to 1985. Folks, we are at the historical average. Nick from Reventure Consulting is showing you that, you know what? It is bad, no doubt. But if you zoom out, it is not historically bad. So at the end of the day, I want to thank Nick from Reventure Consulting for showing us exactly why the Crash Bros are wrong, why the Crash Bros were wrong last year and the year before, why the Crash Bros are again wrong today. I think Nick has an amazing ability to put together graphics and charts and colors that just scream value. And this is one that, again, I think will really dent what the Crash Bros have been telling you for 3 years, folks. They're just wrong. The Crash Bros are wrong. They are out there to do porn. They are out there to take your, clicks so they get paid. In fact, many of the Crash Bros are out shopping for real estate, which I think is really, really interesting. All right, folks, take care. Have an amazing day. Reventure Consulting, Nick, great job. You produce amazing charts, very valuable. Thank you.